Hey folks, welcome back to the channel. This is Jason, host of Fighting Words Financial, and let's talk a little bit more about the economy. Now, if you've been watching any of my live streams over the last couple of weeks, I've been talking about how I think that the economy is already probably in recession. We won't really know until the data is in, but then I've explored ideas that are sort of counter to that assumption as well, talking about some of the data points that don't necessarily line up and saying that the data at this point looks a bit mixed. It's really kind of hard to tell, but I'm on the side that we're already in recession. Well, based on the analysis here from Bill Ackman about the current situation, I'm perfectly willing to admit that I'm probably wrong in this respect. What we're going through right now is not going to fit the definition of, at least academically, the definition of a recession. We are going to see some companies have declining earnings, particularly the ones that don't have any pricing power. But the bottom line is here is that we are doing something a little bit different because of inflation here, and we may not actually be going into a recession. So what I'm going to do is share a thread that Bill Ackman, a famous investor, put out over the weekend. This is actually shared in my Patreon group through our Discord chat, and every once in a while I bring you guys things from that Discord. This is also a great illustration as to why I never really think that Twitter is a great investment, because I realize that most people consume Twitter in a secondhand manner. I never would have seen this on my own. I have a Twitter account. Well, not really. I haven't logged in a couple of years. I never look at it. I'm never aware of any tweets unless somebody brings it to me like secondhand, like in this case, where someone actually sent me a link to Twitter. The issue here is, like, usually when somebody sends me a link to a newspaper article on Twitter or something like that, that is monetizable. But Twitter looks like a business to me that's relatively hard to monetize. Anyway, that is beyond the point here. I'm just thinking about Elon Musk walking away from the Twitter deal. But let me get back to the economy in general here, and let's talk about what Bill Ackman has to say. Now, he's stating that over the past 2 weeks, rates have declined. He's talking about interest rates on loans and bonds and that sort of thing have declined dramatically, purportedly due to fears of recession. Friday's move was particularly stunning for the scale of the move and for the degree of intraday volatility. I put forth here a theory of what is going on. So he's talking about the dramatic drop in rates and how volatile they were during the day too. It just was kind of out of the ordinary. So let's talk a little bit. He goes on to say, on the risk of a recession is defined as 2 quarters of decline in real as opposed to nominal GDP. Real GDP meaning when inflation is factored in, as opposed to nominal GDP, which is just the strict dollar amount spending. In a highly inflationary economy, it is more difficult for nominal spending and growth to exceed inflation. In order, therefore, for today's economy to grow on a real basis, nominal GDP growth must be greater than 8.6%, which is a difficult hurdle to exceed. It has been 40 years since we've experienced inflation at current levels, and market participants are used to a world with 4 to 5% nominal GDP growth and 2% inflation. With inflation at 2%, nominal GDP growth would only need to decline from 4 to 5% to less than 2 to 3% for 2 quarters in a row for real GDP to be negative and for the economy to be deemed in a recession. 2 quarters of negative GDP growth does not however, seem to be a reasonable definition during a period with high inflation, particularly when inflation has spiked to nearly 9%. Nominal spending growth of 8% for the last 2 quarters would technically put us in a recession, but this does not make sense fundamentally. The economy is continuing to grow on a nominal basis. Consumers are spending substantially more this year than last. There are about 2 times as many job openings than people looking for work. The unemployment rate is at a 50-year low. Wages are rising substantially, and it's hard to find workers. Q2 revenues and earnings growth should be strong for most businesses, with earnings misses and margin declines for some companies which have limited pricing power. Consumers have approximately $2.5 trillion of excess savings, while there's a mixed shift underway from goods to services. And that is something that, at least anecdotally, I've been observing myself as I've been traveling a little bit this summer. Airports are packed. People want to do things and want to experience things. They're not necessarily wanting to buy goods right now. They want to go out and experience everything they haven't experienced in the last 2 years. So Bill Ackman goes on to say that overall demand is extremely strong. We have a supply, not a demand problem. And this is the one thing that I have trouble hammering home to people, is that This is all supply shock. This does not seem like a setup for a true economic recession, regardless of the favored definition. So why have rates declined so dramatically, particularly short rates, when the Federal Reserve has become increasingly strident about the need for aggressive tightening to bring inflation back down to 2%? I believe the answer is largely due to some misunderstanding about what a recession is, but more importantly, technical factors that are driving volatility and the downward move in rates. Market participants speculating in the fixed income market, particularly hedge funds, often use enormous amounts of leverage because it is available, and it allows one to make windfall profits if you get the trade right. The bet that rates would increase became one of the more crowded trades in history going into June 15th, as speculators covered their shorts on Fed news. Rates began to decline, causing substantial mark-to-market losses, particularly for leveraged participants who were forced to choose to cover, with more data points emerging indicative of a slowing economy. The recession narrative took hold, causing a further decline in rates, contributing to more losses and short covering. And going into the quarter, when exposures are required to be disclosed in investor reports and financial statements, meaning that at the beginning of the new quarter, you have to publicly disclose the information about your trades and all that stuff, all the stuff that you kept secret last quarter. So extremely limited liquidity going into the July 4th holiday compounded the move and the volatility and pain for leveraged market participants as traders looked to, and in many cases were forced to exit or didn't wish to hold open positions over the long weekend. So what happens? From here, Powell has committed to do whatever it takes to quell inflation, even if doing so causes an increase in unemployment and a recession. Inflation is not coming down soon. Housing, rental costs, energy, ag, and food supply are constrained, and prices are unlikely to abate for the foreseeable future. Wages are continuing to rise as immigration has been limited, and many have exited the workforce, or the balance of power has gone from companies to their labor forces. Companies are raising prices because they must do so in order to cover their costs because they can. The wage price spiral is underway. While demand is moderating due to sticker shock and inflation, as well as rising rates, overall demand remains strong. Inflation has become embedded and is a daily experience in headline news and at dinner. It's a dinner topic for all. Savings bonds pay 9.62%. In order to stop the inflationary spiral, the Fed will need to rapidly raise rates to 4 to 5% by next year, which hopefully will be enough to snuff inflation. The mild transitory inflation being priced by markets as of Friday is a fiction. Rates are going up a lot and soon. The sooner the Fed quells inflation, the better for long-term bonds and long-term financial assets and equities. Don't be misled by short-term, technically driven market movements. Stocks of high-quality businesses with long-term growth and pricing power look cheap. Don't forget that the stock market measures nominal business value. Inflation is hurting businesses and customer confidence. It's slowing growth. Killing off inflation will save the economy in the longer term at the expense of short-term pain. Let's hope the Fed gets it right. I welcome your input and rebuttals. And yes, we put our money where our mouth is. I have often wondered why investors who share their views are often criticized for holding investments on which they will profit if the views they share turn out to be correct. We are 100% long, high quality growth businesses with pricing power and own hedges on which we will profit if rates rise. Our positioning, as always, matches our thinking and stated views. So I have a lot of respect for Bill Ackman. He doesn't call everything correct, but I have to be honest with you in this case. I was having a lot of these thoughts and was sort of unable to organize them into a coherent message over the weekend or so. And he just sort of encapsulated perfectly pretty much everything that I was thinking, that we're going into what's called an earnings recession, where the companies that don't have pricing power are the ones that look like they're going to suffer. And it doesn't mean that demand in the overall economy is slowing. It could be growing. I don't want to say the word stagflation, but I'm going to mention the word stagflation. It's definitely too early for that. We usually have that definition sort of over a much longer time period. But it's not necessarily all bad. There are lots of opportunities out there, but I think this is one of the best sort of roundups of all the information and theories about what's going on in the economy today. Let me know what you guys think in the comments below. I'd be happy to hear from you, and I will see you next time. Thank you.